Hi guys, welcome back to another YouTube video. This video is going to be part of a three-part series, new series on the channel that I'm going to be breaking down some ICT concepts that I have learned in the last 11 months since I started trading, and how I put all of these concepts together and execute it with the model that I use. So with that being said, let's get into it. Okay, so kill zones. So everything here is referenced in Eastern Standard Time, and there are three kill zones. That is the Asia, the London, and the New York kill zone. Some people will reference these as sessions, trading sessions. So when somebody asks you what session do you trade, you could say Asia, London, or the New York session. Now, what trading sessions should you trade? That is something that you have to decide, and you should know that every trading session has different types of volatility. So for example, the Asia session is going to have a lot less volatility than the New York AM session. So starting off with Asia, the window where you'll find the best movement for that session in essence is from 8 p.m. to midnight. And then going forth, you have the London session, which is from 2 a.m. to 5 a.m. with the London Stock Exchange opening at 3 a.m. Eastern Standard Time. So it's more often than not from 3 a.m. to 5 a.m. that might be the window where you'll actually find a setup, because that's when volatility is coming into the market. Moving on to New York AM, pre-market opens at 8:30 and usually ends at 9 or 9:30. It's that hour period before the New York Stock Exchange opens, the opening bell at 9:30. So at 9:30, that is the time to be really aware of. That is when the, obviously, as I said, opening bell opens for the market, and you will see a lot of volatility, a big injection, usually around that time, that first 15 to 30 minutes. There's a lot of movement within the market, more often than not. Then you have lunch. So after around going into like 12 to 1 p.m., that is around lunchtime. You don't really want to be trading around lunchtime if you're trading these kill zones. So make a note of that. And then you have the PM session. So this is when the big boys, I like to say, come back from their lunch, and the PM session starts. In my opinion, even though I've got it here as 1:30, I find that it can also more or less be better to trade from 2 p.m. to 4 p.m. if you're trading the PM session instead. Okay, so moving on to candlesticks now. Now, depending on what time frame you're on, we're going to use the 5-minute time frame as an example. And that means every 5 minutes, a new candlestick is printed, and it's either going to be a bullish candlestick or a bearish candlestick. In this example, we're going to use a bearish candlestick to show you how it prints. So what happens is, when price of the previous candlestick has closed, a new candlestick will basically print. So it will open, and if it's ending up to be a bearish candle, it will have a wick high, where it will then have a wick low, and then it will end up closing lower than the opening price. That is how a bearish candlestick is printed. So it looks like this. So it will open, a new 5-minute candle will open, it will then put a wick high, it will then trade lower than the opening price, it will then end up putting in a wick low, and then when it closes near that 5 minutes, it will close above the wick low, and it will look like this. So open, high, low, close. A bullish candlestick is a bit different. So a bullish candlestick, new candlestick now is printed, it will open, it will put a wick low, it will trade higher than the opening price, it will have formed a wick high, and then it will end up closing like that. So it goes open, low, high, close. So this is how candlesticks are formed. You have the bodies here. So there's a saying that says wicks do the damage, and then the bodies tell the stories. Think of the wicks as a snail trail in price action. That is the best way for me to explain it. So just to recap, a bearish candlestick is when price trades lower than the opening of that price on that candlestick, and a bullish candlestick is when price trades higher than its opening and closes higher. Okay, moving on to swing points, and there is no reason to overcomplicate this. It's so simple. A swing point is easily identified in a 3-candlestick pattern. A swing low can be identified when the middle candle, for example, has 2 candlestick wicks that are higher than said middle candle's wick. So because these are higher than this candle's wick, this is now defined as a swing point, and you can see that because now price has traded higher. Over here, we have again a swing high because this candle wick made the high, and then the two candlesticks next to it are lower. And what does price do? It confirms it as a swing point because price has now moved lower. So after it's moved lower, again, what happens? It creates the three candlestick pattern where this low is the lowest and it has two candlesticks wicks next to it that are higher. So we have swing low, swing high, swing low. So how it looks in a bullish uptrend, in this example, which this is a bullish uptrend, we have a price comes down, forms a low, puts in a high, puts in a higher low, higher high, higher low, and you get the gist. So this is a bullish example. A bearish example would just be the opposite, where price creates a swing low, creates a lower high, lower low, lower high, lower low, lower high. No need to overcomplicate it. That is what a swing point is. Okay, so moving on to a fair value gap, known also as an FVG. What is it? The simplest way for me to say this is when price moves in a certain direction, it will leave an imbalance within the market. That imbalance will later likely want to be filled, so rebalanced, and then depending if it's bullish or bearish, move higher or lower off of that FVG. So in a bullish example, it's a fair value gap is a three candlestick pattern. It's when the first candle's wick high and the third candlestick wick low leaves a gap between it. So over here we have a fair value gap, a bullish fair value gap that price will likely seek back into to push off higher. Now moving over to a bearish fair value gap, it's still that same three candlestick pattern that you see here. And as you can see, it left this imbalance. Price then retraces back into that imbalance to then push off lower. That is what a fair value gap in plain and simple terms. Okay, that's a wrap of part one. In the next video, I'll be releasing part two, which will be a bit longer, and it'll be going over the topics as seen on the screen. So I hope you guys enjoyed, found this video insightful. If you did, leave a like on the video, subscribe, and maybe check out the Discord link in the description. Take care, guys. Bye-bye.